Why do you think that this is the right system, combining sort of a cash and a credit and savings in one?
First, thank you for having me. So with Brex Cash, we try to solve all the financial problems of our customers. So no matter how you want to pay, if you want to pay through card, wires, or ACH, or any method that you want, you can do it in one single place. And then the second thing is that banks traditionally, they separate between checking and saving accounts. So you earn less interest on your money as a whole. With Brex, we simplified it into one account that earns 1.6% yield. So there's no more complication of like having one account that doesn't earn, the other one that earns, and you have to move around. They're just 1.6% all the time.
How are you making money?
So we invest all the funds in money market funds, from which we gain a little small fee from that. And also, we believe that by having the same account between card and cash, people will end up spending more on our cards, in which we make money through interchange.
And is the cash insured by the FDIC?
No, the cash is not insured by the FDIC. So we buy money market funds that consist basically of US securities, so government-backed securities, and it's also covered by SIPC insurance.
You know, there's been a lot of new entrants into this marketplace recently. I look at companies like Square and Fundbox and Cabbage. Do you worry that you're flooding the market with too much credit?
So most of Brex customers, they want our card despite credit. So they might get a loan from Square or Fundbox, but they still need a card to swipe and use those funds. And they still need an account like Brex Cash to pay their vendors and employees, etc. So we think that we're giving more of them access to spend their money instead of the credit itself.
And who is your target customer?
So today we target three main verticals, which is venture-backed startups, e-commerce companies or online brands, and life sciences companies.
I wonder, do you do better when the Fed is raising interest rates because you can really capitalize on that spread? Or does your business model work better when the Fed is cutting interest rates because rates are lower?
So it's a question we get all the time from investors, and we mostly do better when interest rates are lower, because from our card it reduces our cost, and from a technology perspective, if rates were zero, every bank would be competing for customers in terms of technology and service, and we believe that that's our main competitive advantage.